So, you're committed. You want to buy a rental property, but how do you know what is good or a bad investment? Regardless whether you choose to invest in commercial properties, single-family homes, condos, or apartment blocks, each of these properties should be evaluated for their performance, so we're going to talk about a universal term most real estate investors use to calculate their rate of return, which is the cap rate. Now, cap rate, or capitalization rate, is used in the world of commercial real estate to indicate the rate of return that is expected to be generated on a real estate investment property. It's computed by taking the net income the property is expected to generate and dividing this by the property asset value or the market value, and it's expressed as a percentage. For example, if you purchase an apartment block that generates $70,000 in net income per year and it's worth $1 million, well, you take $70,000 divided by 1 million equals 7%. Side note here, any debt servicing, like mortgage payments, is not to be included in this calculation. It's only the net income of the property. So if you have a mortgage or other kinds of payments towards debt, you would take those out of the net income before performing the calculation. While the cap rate can be useful for quickly comparing the relative value of similar real estate investments in the market, it should not be used as the sole indicator of an investment's strength because it doesn't take into account leverage, the time value of money, and any future cash flows from property improvements. So you might be asking, what is a good cap rate? Well, the internet gives generalities but doesn't seem to want to commit to a number. Most good cap rates are between 4 and 10%. The most important thing, use the cap rate to compare assets within the same asset class. For example, you wouldn't take an apartment block cap rate of 6% and think it's better than a 4% cap rate on a single family home because they're completely different assets. And side note number 2, because cap rates use net income in their calculation, they're not really supposed to be used to evaluate things like flips, land, vacant property, even vacation rentals or short-term properties. Vacant land or properties is obvious. There is no net income to use in the formula. And short-term rentals and vacation rentals skew the numbers a little bit because they're normally calculated, on a day or weekly basis, while cap rates are based on annual income. For the next series of segments, I'm going to be discussing the different types of rental properties, and we'll be starting with commercial properties. Thanks for watching.